today's video, we're going to go over how you can supercharge your Roth conversions with a brokerage account and pay less taxes by doing it this way. Now, this involves where you take some of your distributions for your income. Does it matter which account you take them from? Well, the answer is yes. By taking it from certain accounts, you can pay less in taxes. We'll show you an example of this. And then by doing it this way, does it give you the ability to supercharge your Roth conversion strategy? It does. We're going to go over it next. Hey, my name is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we're helping federal employees plan for a better retirement. If you need individualized help, go to christycapital.com. One of the biggest expenses you'll have in your lifetime will be taxes, so planning for them is vital. Is there a way that you can supercharge your Roth conversions while using a brokerage account and pay less taxes overall just by figuring out where your distributions in retirement should come from? Yeah, the answer is yes. Let's go over it. So we have a case study here. These are actual client numbers where we change the names, but the numbers remain. So in this instance here, they have an income of $56,521. They need to take out about $20,000 in distributions throughout the year to fund their lifestyle. And so you can see here that they're taking the distributions from their IRA, and so that would be taxable. They'd have a gross income of $76,521. To simplify things, when you apply the standard deduction to that, they have a taxable income of around $46,521, which puts them in the 12% bracket. Now keep in mind, on the $20,000 IRA deduction, they are paying 12% on that money. And it turns out that they have a non-qualified brokerage account with just regular money in it that's not retirement money. What if they took their distributions from that account instead of the IRA? Well, their other income of $56,521 would be the same, but in this case, they took $20,000 of distributions from their non-qualified account, and it turns out with non-qualified accounts, when you're in the 12% tax bracket, the long-term capital gains rate is actually zero. In this person's case, they had $5,437 of short-term capital gains, which would be taxable now, but the other $14,600 or so is tax-free because they're in the 12% bracket and long-term capital gains rate is zero. So because of that, you can see here their taxable income would be $31,958. Their income is lessened by the fact that they were able to take a tax-free long-term distribution from their non-qualified account. So in this case, they paid less taxes because they took their monthly distribution from a brokerage account that had long-term capital gains in it. It's awesome. Let's think about Roth conversions. What if with the 12% bracket, you think it's just a steal and you would like to fill up the available 12% bracket by Roth converting? If you took your lifestyle distributions from the IRA, you would have around $50,000 that you could Roth convert in the 12% bracket. But if you took your distributions to fund your lifestyle from the non-qualified account, like we mentioned earlier, where your taxable income was only $31,958, you end up having about $65,000 worth of room to Roth convert, which means you could Roth convert almost $15,000 of extra dollars just because you took your monthly distributions from the non-qualified account that had a tax-free long-term gain in. Well, what's the big deal? It's just an extra $15,000. Well, if you can do this every year for the next 10 years, it can be a big difference where you're only paying 12% on that money as opposed to getting bumped into the 22% bracket. Not Roth converting now in the 12% bracket may mean that later on, you're going to have to pay taxes with, when your RMD start at an even higher rate. So being able to Roth convert an extra $15,000 by doing this type of planning is a huge deal. Now, not only are you getting to take tax-free gains from the non-qualified account using the long-term capital gains rate being zero, but it also gives you a little bit more room to do Roth conversions. That's definitely supercharging your Roth conversion strategy, the brokerage account, and paying less taxes. This is the kind of next level planning that the right advisor can help you with. Knowing the tax code to allow you to take some tax-free gains from an ordinarily taxable account just because you know the rules is key to getting the most out of your retirement. If you need help with your retirement planning and you want to work with somebody that knows your federal system, but also pays attention to the taxes as well, reach out to us at christycapital.com. Coming in March 2025, we're releasing a book on your FERS Federal retirement, the 10 decisions that could make or break your retirement. So definitely check that out if you're planning on retiring in 2025. If you need one-on-one help, reach out to us. If you're wondering if you're required to take minimum distributions from your TSP, and can that cause you to pay higher taxes, check out this video right here. My name is Mel Stubbs. I'll see you on the next video.